I was thinking in Ben Graham's book, The Intelligent Investor, he spends the first couple of chapters discussing the level of the market and whether it was safe for investment. I was wondering what he'd think of the market today.
Well, we don't, Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, and we don't think of stocks as little items that wiggle around in the paper and that have charts attached to them. We think of them as parts of businesses, and it is true that currently we have great trouble finding businesses that we both like and where we like the managements, and find them at an attractive price. So we do not find bargains in this market among the larger companies that are our universe. That is not a stock market forecast in any way, shape, or form. We have no idea whether the market's going to go up today or next week or next month or next year. We do know that we will only buy things that we think make sense in terms of the value that we receive for Berkshire. And when we can't find things, the money piles up. And when we do find things, we pile in. But the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses and buying them at sensible prices. And that's what we're hoping to do. Charlie?
How could you say it any better?
Yeah, but the question is whether you can say it better, Charlie.
I think the other half of the question was about investments. Do you have any rule of thumb about when you give up on or when you realize it?
Well, again, I mean, I love it when the things we buy go down. I mean, I get euphoric, you know. Stocks are down today, and I'm buying more of something I was buying yesterday. I'm buying it cheaper. Now, when you go to the grocery store and you buy something cheaper than you bought it the day before, you think that's terrific. But people with their stocks, they think that the stock knows more than they do. So that when the stock goes down, they say the stock is telling them something, you know. And what it's telling me is I can get more for my money. but they take it as kind of a referendum on themselves, you know. And it's me versus the stock. If it ever gets back to what I paid, I'm going to sell it. The stock doesn't care what you paid. I mean, you have to remember, the stock doesn't even care that you own it. You are nothing to the stock. That stock is everything to you, you know. And you remember you paid $10.13, and therefore the stock should get to $10.13 before you sell it. You know, the stock has no feelings about you. You know? I hate to disillusion you on this, but it just doesn't care. And so the only question with every stock every day, and you don't do it this frequently, is can I get more for my money someplace else? You've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change. And you can make the exchange at very low cost these days. Commissions are nothing. So you can always shift from one business to another. You have a huge advantage over Andrew Carnegie. You know, when he was in the steel business, he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing or something like that. You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, you know, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
There was an article in the April 18th Barron's that attempted to calculate the value behind each Berkshire Hathaway share. I'm sure you have some views on that, and I'd be very interested in your perspective on that issue.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago, reaching pretty much the same conclusion, and I hope he hasn't been short in between. But I would say this: it is not the way I would calculate the intrinsic value of Berkshire. But everyone in securities markets makes choices on that. Every day somebody sells a few shares of Berkshire and someone buys, and you know, they are probably coming to differing opinions about about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not total. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane.
And my question concerns your comment this week about the recession and the stock market going up so significantly in April. Can you expand on where the market's going from here?
Well, I could expand, but I couldn't answer. Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. It never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market, where there wouldn't be any reason to look at businesses and stocks. So it's just not our game. We don't think what we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields. You'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves. Charlie?
Nothing to add.
He's been practicing for weeks.
Understanding your theory that sort of a down market is good for net savers, can you sort of give us your thoughts as to where the market's going, its downward trend, and long-term profit or long-term profit obviously?
Well, I've got no idea where the market's going to go. I prefer it going down, but I haven't. My preferences have nothing to do with it. The market knows nothing about my feelings. That's one of the first things you have to learn with a stock. You buy 100 shares of General Motors. Now all of a sudden you have this feeling about General Motors. I mean, if it goes down, you may be mad at it. You may say, well, if it just go up to what I paid for it, my life will be wonderful again. Or if it goes up, you may say how smart you were and how you and General Motors have this love affair and everything. You've got all these feelings. Stock doesn't know you own it. Stock just sits there. It doesn't care what you paid. It doesn't care that you owned it or anything. So any feeling I have about the market is not reciprocated. I mean, it is the ultimate. It is very cold shoulder we're talking about here. And anybody that is going to be a net saver, practically everybody in this room is more likely to be a net buyer of stocks over the next 10 years than they are a net seller. So every one of you should prefer lower prices. I mean, if you're going to be a net eater of hamburger in the next 10 years, you want hamburger to go down unless you're a cattle producer. And if you're going to be a buyer of Coca-Cola and you don't own Coke stock, you hope the price of Coke goes down. I mean, you're looking for it to be on sale this weekend at your supermarket. You want it to be down on the weekends, not up on the weekends when you're going to attend the supermarket. Your stock exchange is a big supermarket of companies, and you're going to be buying stocks. What do you want to have happen? You want those stocks to go down, way down. And, you will make better buys then. And later on, 20 years from now, 30 years from now, when you're in a period when you're dis-saving or when your heirs dis-save for you after you're gone, I mean, then you may care about higher prices. But I find people, that was one of the, there's a chapter 8 in Ben Graham's Intelligent Investor about the attitude towards stock market fluctuations. And that and the chapter 20 on the margin of safety are the two most important essays ever written on investing as far as I'm concerned. Because when I read chapter 8, when I was 19, I figured, I just figured out what I just said, but it's obvious. I didn't figure it out myself, though. It was explained to me. I'd probably gone another 100 years if I had read it. Still thought it was good when my stocks were going up. No, we want things to go down, but I have no idea what the stock market's going to do. I never do. I never will. It's not something that I think about at all. When it goes down, I look harder at what I might buy that day. Because I know there's more likely to be some merchandise there that I can use my money effectively in.
In 1999, Berkshire Hathaway managed to produce a positive gain in net worth of 0.5%. That means that since present management took over 35 years ago, Berkshire Hathaway has realized a positive gain each and every year and produced an average annual gain of 24%. Including the years you ran the Buffett Limited Partnership, you have had a run of 48 consecutive years of positive gains in net worth without one single down year, producing a compounded rate of return of almost 26% annually. On behalf of the long-term shareholders of Berkshire Hathaway, we want to thank you from the bottom of our pocketbooks.
No, thank you. I hope your question isn't going to be whether we can continue that, but go ahead. Do you have a question?
My question is, don't you think you could have ended the millennium with a bigger bang than 0.5%?
Well, I certainly wish we could have, but the interesting thing about those figures, actually the figures go back before that, because the very best period was pre the partnership days, but because the amount I was working with was so small. But there's nothing magic about a 1 year period. I mean, it's the way the measurements come out. If you took all the half-year periods, for example, I'm sure, well, I know that there were a number that were down, and there are going to be lots of years in the future, assuming I live long enough. We will have plenty of down years. It's been a fluke to some degree that we have not had any down years in terms of underlying value. The stock has gone up and down in ways that are not related to intrinsic value a few times. But that is totally a fluke. I mean, we're not going to be up every day. We're not going to be up every week. We're not going to be up every month or even every year. And it's the fact that, the Earth revolves around the sun and really is not totally connected to most business activities. Or the fruition of most investment ideas or anything of the sort. So we have to report every year, and I care about the yearly figures in that sense. I don't really care about them totally as a measure of what we're doing. Like I say, if we could have, the capital allocation job that I did in 1999 was very, very poor, and it was partly because some of our main businesses did poorly. I mean, Coca-Cola and Gillette had bad years last year. They'll have good years over time. I wrote a few years ago. It's interesting. I called their soft drink business and their razor and blade business as inevitables, and the truth is they've got a higher market share now than they've ever had in history. They're selling more units than any year in history, but certain other factors hurt their business and therefore hurt their stock performance. But I would still call the soft drink, Coca-Cola's position in the soft drink business and Gillette's position in the razor and blade business, I would characterize them as inevitable, that they will that they will gain share over time. Gillette has over 70% of the share of the blade and razor business in the world, which is measured by value. You know, that's an extraordinary share. Coke has 50% of the soft drink business in the world. That's well over 1 billion 8-ounce servings per day, 1 billion per day. 8% of those are for the account of Berkshire. So over 80 million 8-ounce servings of soft drinks per day are being consumed by people for where the economic benefit comes to Berkshire Hathaway. In effect, we have over 6% of for Berkshire Hathaway's account of the blade and razor business in the world, and it'll go up. So I don't worry about the businesses in the least long term. They will have bad years from time to time, and when they do, our performance will not look good in those years. Charlie?
Well, it's been a very interesting stretch. One of the most interesting things about the stretch is that during pretty much the whole period, the company has owned marketable securities in excess of its net worth. And so you have this extraordinary liquidity in a company that has performed very well to boot. That advantage has not gone away, and in fact it's been augmented. Give us reasonable opportunities, and we are prepared.
I know, Mr. Buffett, that you've said that you don't read what other people say about the market or the economy, but do either you or Charlie have an opinion about how you think things are going to go? Are you bullish or bearish?
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know, and to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. I mean, I bought my first stock, I think, in probably April of 1942 when I was 11, and since then, I mean, actually World War II didn't look so good at that time. I mean, the prospects, they really didn't. I mean, we were not doing well in the Pacific, and I'm not sure I calculated that into my purchase of my 3 shares. But I mean, just think of all the things that have happened since then, atomic weapons and major wars and presidents resigning and all kinds of things, massive inflation at certain times. To give up what you're doing well because of guesses about what's going to happen in some macro way just doesn't make any sense to us. The best thing that can happen from Berkshire's standpoint, we don't wish this on anybody, but over time is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. Now, if you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. I mean, what we fear is an irrational bull market that's sustained for some long period of time. You as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. But we have no idea what and we wouldn't care what anybody thought about it. I mean, most of all ourselves. I mean, Charlie, do you have any?
No, I think if you're agnostic about those macro factors and therefore devote all your time to thinking about the individual businesses, and the individual opportunities. It's a way more efficient way to behave, at least with our particular talents and lacks thereof.
If you write about the businesses, you'll end up doing fine. We don't know, and we don't think about when something will happen. We think about what will happen. It's not so difficult to figure out what will happen. It's impossible in our view to figure out when it will happen. So we focus on what will happen. This company in 1890 or thereabouts, the whole company sold for $2,000. It's got a market value now of about 50-odd billion. You know. Somebody could have said to the fellow who was buying this in 1890, you know, you're going to have a couple of great world wars, and you know, you'll have the panic of 1907. All these things will happen. And wouldn't it be a better idea to wait? You know? We can't afford that mistake, basically. Yeah.
Back in October of 2008, you highly recommended buying U.S. stocks, and that was a brilliant idea. It worked very well. And I just want to get your opinion, how you think about the market going forward. Are you still that optimistic? And what's the reasonable rate of return to expect from the equities in the next decade or so?
Well, I write articles very infrequently or get interviewed very infrequently on the subject of the general level of the market itself. Probably only 4 or 5 times in 40 years have I really declared myself about what I thought about the general level of the stock market. And it turned out I was pretty premature, actually, in October of 2008, as was pointed out to me by a number of people. But I felt, and what I said in that article really was that it would be way better to own stocks over the long term than to follow a policy of buying either long-term bonds or holding cash. And I knew I could make that statement, and I would be eventually, I thought odds were very high I'd be proven right on that. But I don't know what the stock market's going to do next week or next month or next year. I don't have any idea. People always think I do. I know I don't have any idea. I don't think about it. It doesn't make any difference. Charlie and I can't recall a discussion we've ever had on it, you know, basically. But I do think over the next 10 years or 20 years, I'd much rather own equities, including U.S. equities. I'd much rather own them than cash, or I'd much rather own them than a 10 or 20-year bond. But that's partly because I'm very unenthusiastic about the alternatives. I think equities are likely to give you some positive, modest positive, real return over time. But beyond that, I really don't know anything. Charlie?
Well, that's a cheerful thought, that equities are the best of a bad lot of available opportunities.
Do you disagree with it?
No, I think you're right. I think people should get accustomed, on average, to doing less well in their investment portfolios in real terms.
Charlie and
I think we're in for a long period of where the ordinary result is not going to be very exciting.
But we like owning businesses, and we're in a position where we can own entire businesses. But we also like partial ownership of businesses, and we want to own businesses where we really think they have some competitive advantage over time, and where we feel good about the management, and where we think the price is reasonably attractive. I think you can find things like that now, but they aren't dramatically attractive at all. They do beat, in my view, they do beat holding cash or 5, 10, or 20-year bonds.
In an interview with Becky yesterday, Mr. Munger commented that in the old days, the vast majority of Berkshire's value was embedded in the investment portfolio, which is presumably worth around book value. Today, the majority is in the controlled businesses, which we believe are worth a substantial premium to book. In light of this, Berkshire Hathaway's intrinsic value as a multiple of book value should be increasing over time. Yet Berkshire's price to book value has been declining. I'm trying to understand this. Since the beginning of the year, since the beginning of last year, Berkshire's investment portfolio has increased in value by $20 billion, and you acquired Lubrizol. The controlled businesses are going gangbusters. Yet the stock price hasn't budged. Is Mr. Market simply in one of his manic moods?
Charlie?
Well, I'd say no, but I'd say it's in the nature of things that the market is not going to do exactly what you want when you want it. I think over time, Mr. Market will treat the Berkshire shareholders fine, and I wouldn't worry too much about what happens over this 6 months or this 12 months. I don't think you're really all that welcome in this room if the short-term orientation is what turns you on.
I think you'd agree, though, that probably that Berkshire is somewhat cheaper relative to its price than it was a year ago.
Yes, absolutely. If that's your test, should you feel better about the margin of safety in Berkshire? Yes, it's fine.
But going back to stocks, people bring the attitude to them too often that because they are liquid and quoted minute by minute, that it's important that you develop an opinion on them minute by minute. Now, that's really foolish when you think about it. And that's something Graham taught me in 1949. I mean, that single thought. Stocks were parts of businesses and not just little things that moved around on charts. Or charts were very popular in those days, and whatever it may be. Imagine for a moment that you decided to invest money now, and you bought a farm. And the farmland around here, let's say you bought 160 acres, and you bought it at X per share, or per acre. And the farmer next to you had 160 identical acres, same contour, same quality of soil quality. So it was identical. And that farmer next door to you was a very peculiar character, because every day that farmer with the identical farm said, "I'll sell you my farm, or I'll buy your farm at a certain price," which he would name. Now, that's a very obliging neighbor. I mean, that's got to be a plus to have a fellow like that with the next farm. You don't get that with farms. You get it with stocks. If you own 100 shares of General Motors, on Monday morning, somebody will buy your 100 shares or sell you another 100 shares at exactly the same price, and that goes on 5 days a week. But just imagine if you had a farmer doing that. When you bought the farm, you looked at what the farm would produce. That was what went through your mind. You were saying to yourself, "I'm paying X dollars per acre. I think I'll get so many bushels of corn or soybeans on average. Some years good, some years bad. Some years the price will be good, some years the price will be bad, etc." But you think about the potential of the farm. And now you get this idiot that buys a farm next to you, and on top of that, he's sort of a manic depressive and drinks, maybe smokes a little pot. So his numbers just go all over the place. Now, the only thing you have to do is to remember that this guy next door is there to serve you and not to instruct you. You bought the farm because you thought the farm was had the potential. You don't really need a quote on it. If you bought in with John D. Rockefeller or Andrew Carnegie, and there were never any quotes. Well, there were quotes later on, but basically, you bought into the business, and that's what you're doing when you buy stocks. But you get this added advantage that you do have this neighbor who you're not obliged to listen to at all, who is going to give you a price every day, and he's going to have his ups and downs, and maybe he'll name a silly price that he'll buy at, in which case you sell if you want to, or maybe he'll name a very low price and you'll buy his farm from him. But you don't have to, and you don't want to put yourself in a position to where you have to. So stocks have this enormous inherent advantage of people yelling out prices all the time to you. And many people turn that into a disadvantage. And of course, many people can profit in one way or another from telling you that they can tell you what this farmer's going to yell out tomorrow or next, your neighboring farmer's going to yell out tomorrow or next week or next month. There's huge money in it. So people tell you that it's important and they know, and that you should pay a lot of attention to their thoughts about what price changes should be, or you tell yourself that there should be this great difference. But the truth is, if you owned the businesses you liked prior to the virus arriving, it changes prices and it changes, but nobody's forcing you to sell. And if you really like the business and you like the management you're in with, and the business hasn't fundamentally changed, and I'll get to that a little when I report on Berkshire, which I will soon, I promise. The stocks have an enormous advantage, and you still can bet on America, but you can't bet unless you're willing and have an outlook to independently decide that you want to own a cross-section of America, because I don't think most people are in a position to pick single stocks. A few maybe, but on balance, I think people are much better off buying a cross-section of America and just forgetting about it. If I'd done that when I got out of college, it's all I had to do to make 100 for one, and then collect dividends on top of it, which would increase substantially over time. The American tailwind is marvelous. American business represents, and it's going to have interruptions, and you're not going to foresee the interruptions, and you do not want to get yourself in a position where those interruptions can affect you, either because you're leveraged or because you're psychologically unable to handle looking at a bunch of numbers. If you really had a farm and you had this neighbor, and one day he offered you $2,000 an acre, and the next day he offers you $1,200 an acre, and maybe the day after that he offers you $800 an acre, are you really going to feel that at $2,000 an acre, when you had evaluated what the farm would produce, are you going to let this guy drive you into thinking I better sell because his number keeps coming in lower all the time? It's a very, very, very important matter to bring the right psychological approach to owning common stocks. But I will tell you, if you bet on America and sustain that position for decades, you're going to do better than, in my view, far better than owning Treasury securities, or far better than following people who tell you that what the farmer's going to yell out next. There's huge amounts of money that people pay for advice they really don't need, and for advice where the person giving it can be very well meaning in it and believe their own line. But the truth is that you can't deliver superior results to everybody by just having them trade around a business. If you bought into a business, it's going to deliver what the business produces, and the idea that you can outsmart the person next to you, or that the person advising you can outsmart the person sitting next to you is well, it's really the wrong approach. So.
This question comes from a man who believes the stock, that Berkshire stock is being held down some, but you're talking about the Buffett rule. I know you said you doubt that. But he suspects that at least 95% of the people in this arena believe that Berkshire Hathaway stock is undervalued. If you don't think it's the Buffett rule, could each of you give us your opinions about why the stock stays stuck at these levels?
Yeah, we've run Berkshire now for 47 years. There have been several times, 4 or 5 times, when we've thought it was significantly undervalued. We saw the price get cut in half at least 4 times, or roughly in half, in fairly short periods of time. And I would say this, if you run any business for a long period of time, there are going to be times when it's overvalued and sometimes when it's undervalued. Tom Murphy ran one of the most successful companies the world's ever seen. And in the early 1970s, his stock was selling for about a third of what you could have sold the properties for. And, you know, Berkshire, back in 2001, whenever it was, that I wrote in the annual report that we were also going to repurchase shares, was selling at what I thought was a very low price. And we didn't get any repurchased. But that stocks, the beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. You know, Ben Graham writes about it in chapter 8 of The Intelligent Investor. You know, next, well, chapters 8 and chapters 20 are really all you need to do to get rich in this world. And chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security. So it's built into the system that stocks get mispriced. And Berkshire has been no exception to that. I think Berkshire, generally speaking, has come closer to selling around its intrinsic value over a 47-year period or so than most large companies. If you look at the range from our high to low in a given year and compare that to the range high and low on 100 other stocks, I think you'll find that our stock fluctuates somewhat less than most, which is a good sign. But I will tell you, in the next 20 years, Berkshire will someday be significantly overvalued and at some point significantly undervalued. And that will be true for Coca-Cola and Wells Fargo and IBM and all of the other securities that I just don't know in which order and at which times. But the important thing is that you make your decisions based on what you think the business is worth. And if you make your buy and sell decisions based on what you think a business is worth, and you stick with businesses that you think you've got good reason to think you can value, you simply have to do well in stocks. The stock market is the most obliging, money-making place in the world because you don't have to do anything. You know, you sit there with thousands of businesses being priced at the same price for the buyer and the seller, and it changes every day, and you've got lots of information about most of those businesses, and you don't have to do anything. Compare that to any other investment alternative you've got. I mean, you can't do that with farms. If you own a farm and the guy has the farm next to you and you kind of like to buy him out or something, he's not going to name a price every day at which he'll buy your farm or sell you his farm. But you can do that with, you can do it with Berkshire Hathaway or IBM. It's a marvelous game. I mean, the rules are stacked in your favor if you don't turn those rules upside down and start behaving like the drunken psychotic instead of the guy that's there to take advantage of him. Charlie?
Well, what's interesting about this place is that I think we've had a lot more fun when we got rich enough so we bought businesses and stocks to hold instead of to resell. It's an enormously more constructive life. So as fast as you can work yourself into our position, the better off you'll be.
And you should be very encouraged by the fact that he's only 88 and I'm only 81. Just think, it may take you a little while.
I have read an enormous amount about past market declines and the opportunities they presented to investors. The last 2 years have seemed to me, a 43-year-old investor, a real opportunity. Yet in the thick of the action, I was too scared. because I felt the market decline, while severe, was not necessarily sufficient to match the risks of global financial meltdown. So my question is, given that we are possibly not totally out of the woods, how did the two of you assess this latest buying opportunity against the previous opportunities of your life?
It's not the greatest one. We've seen a few that scream at us, and we've seen a few periods of overvaluation that scream at us. And 90% of the time, we're somewhere in between, and we don't know exactly where we are in between. The business of being scared, you know, I don't know what you do about that. If you're of that, if you have a temperament that when others are fearful, you're going to get scared yourself. You know, you are not going to make a lot of money in securities over time in all probability. You know, people really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. I mean, if you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more. And you know, Ben Graham wrote about it. It's been explained. But if you can't get yourself in that mental attitude, you're going to be scared whenever everybody else is scared. And to expect somebody else to tell you when to buy and therefore get your courage back up or something. You know, I could get this fellow's courage up substantially by saying it's a wonderful time to buy. And then a week from now, he'd run into somebody else that tells him the world is coming to an end. And he'd sell. I mean, he's a broker's friend, but he's not going to make a lot of money. Charlie?
Yeah, I think I developed more courage after I learned I could handle hardship. So maybe you should get your feet wet with a little more failure.
Well, I've certainly followed that advice. No, some people really do not have apparently they don't have the temperament, emotional stability, or whatever it may be, to invest in securities. They'd be much better off if there were no quotations at all. And Keynes talked about that some in the past too. To take something that should be an asset, a quotation every day, you know, terrific liquidity. Nobody says how liquid is my farm or something of the sort. So they're not expecting that prices to tell them something about how they're doing. The market is saying this or that. Whenever anybody says the market is saying this or that, it's sort of unbelievable. But there's a lot of interest in investing, and people are going to yak about it all the time. And in the end, what counts is buying a good business at a decent price, and then forgetting about it for a long, long, long time. And some people can do it, and some people can't.
The subprime crisis has led to inconsistent pricing in capital markets. Credits are trading at large discounts, and at the same time, the equities do not reflect this. My question is, when will this be over, and how do you take advantage of market dislocations?
Well, when there are market dislocations, there are always ways to take advantage of it, but we'll leave for you the joy of searching for those. But there have been some really important dislocations, and I brought along, just for your amusement, a few figures on something that we've done recently, but it doesn't have any big significance for Berkshire. I mean, Berkshire will make some extra money out of this. It doesn't take any time to think about, but it does illustrate just how dramatic the changes were. And the ones I brought along relate to the tax-exempt money market funds. There were 330 billion of these. That's a lot of money, 330 billion. And they relied on repricing of really almost all cases first-grade municipal bonds. Every 7 days they had these auctions, and it was all set up very elaborately so that people could have their money more or less in their minds instantly available in something that was tax exempt. And they were marketed extensively. And I brought along, for example, here's one that related to they were backed by various municipal issues. This happens to be one by the LA County Museum of Art. Just pull that out. And on January 24th, it was marketed at 3.15%. January 31st, 4.0. February 7th, 3.5. February 14th, 8%. Now, how can a tax-exempt bond of short-term nature be selling at a 3.5% rate 1 week, and 1 week later on Valentine's Day be at 8%, and 1 week after that be at 10%? It's now back to 4.2%. Now, those are huge dislocations in markets. That's crazy. It'd be one thing to be some little obscure item, but this happened with billions and billions and billions of dollars of securities. It even happened, we get these bid sheets every day, and this happens to be a bid sheet, I think from Citigroup, and they were repricing these every 7 days. And what you would find on these, you'll see there's lots of issues involved. The same issue would appear on several different pages because it would represent some different auction, although handled by the same broker at the same time. On one page, you would find an issue. We would bid all these. We have to bid these at 11.3%. On one page, we bought them at 11.3%. On another page, the same issue, we bid the 11.3%, and somebody else bid 6%. So you had the same issue with the same broker at the same time being sold at 11.3% and 6%. Those are markets of extreme dislocation, and you find those occasionally. You found that after the long-term capital management crisis in 1998. You found the equivalent of it in the stock market in 1974 and so on. And those are great times to make unusual amounts of money. And there's certain things we can't figure out. I see in the Wall Street Journal, I see advertisements these days of auctions taking place in some esoteric mortgage securities. If you had enough time, you could probably figure out some of those that were very mispriced. We don't fool around with that. We just don't have the time. We were able to do we have about $4 billion in this right now. When we get all through, we'll have made some extra money for a couple of months. It won't be significant in relation to Berkshire's size, but it's something that's very easy to do. You may be able to find by working very, very hard on some smaller issues, you might be able to find in this mess in mortgages, and it's gone beyond subprime. It's gone into all days, and it's gone into option arms and that sort of thing. There very well could be some great opportunities out there that Charlie and I will no longer spot because we just can't be looking at that many things. Charlie?
Yeah, what is interesting is that how brief these opportunities to take advantage of dislocations frequently are. Some idiot hedge fund bought unlimited municipal bonds at, incredible margins. I think they bought 20 times more municipal bonds than they could afford with their own money, borrowing all the rest. And when those things were dumped on margin calls, municipal bonds suddenly got mispriced in America. But the dislocation was very brief.
But very extreme.
But very extreme. And so if you can't think fast and act resolutely, it does you no good. So you're like a man standing by a stream trying to spear a fish, and the fish just comes by once a week or once a month or once every 10 years. And you've got to be there to throw that spear fast before the fish swims on. It's a pretty demanding business if you do it right.
But there have been times, in the junk bond market, there was a 3 or 4 month period in 2002 where some really incredible things happened, and they happened on a large scale. So
yeah, it happens about twice a century.
Yeah. Which means that he and I have only had 4 or 5 times when we could do it.
Mr. Buffett, the recent run-up in the market has been historic, and it seems that many people question the sustainability of the current price level. Do you think the rally is for real?
What's going to happen tomorrow, huh? Well, let me give you an illustration. I bought my first stock in 1942. I was 11. I'd been dilly-dallying up to then, but I got serious. And what do you think the best year for the market has been since 1942, best calendar year, from 1942 to the present time? Well, there's no reason you know the answer, but the answer is 1954. And in 1954, the Dow counting dividends was up 50%. Now, if you look at 1954, we were in a recession a good bit of that time. The recession started in July of 53. Unemployment peaked in September of 54. So until November of 54, you hadn't seen an uptick in the employment figure. And the unemployment figure more than doubled during that period. It was the best year that was for the market. So it's a terrible mistake to look at what's going on in the economy today and then decide whether to buy or sell stocks based on it. You should decide whether to buy or sell stocks based on how much you're getting for your money, long-term value you're getting for your money at any given time. And next week doesn't make any difference because next week is going to be a week further away. And the important thing is to have the right long-term outlook, evaluate the businesses you're buying, and then a terrible market or a terrible economy is your friend. And I don't care in making a purchase of the Burlington Northern. I don't care whether next week or next month or even next year there's a big revival in car loadings or that sort of thing. A period like this gives me a chance to do things, and it's silly to wait. I wrote an article. If you wait till you see the robin, spring will be over.
Warren, why are you recommending listeners to buy now, yet you're not comfortable buying now, as evidenced by your huge cash position?
Well, as I explained, the position isn't that huge when I look at worst case possibilities. I would say that there are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen. I mean, for example, in our insurance business, we could have the world's or the country's #1 hurricane that it's ever had, but that doesn't preclude the fact we could have the biggest earthquake a month later. So we don't prepare ourselves for a single problem. We prepare ourselves for problems that sometimes create their own momentum. I mean, 2008 and 2009, you didn't see all the problems the first day when what really kicked it off was when the Freddie and Fannie, the GSEs, went into conservatorship in early September. And then when money market funds broke the buck, I mean, there are things that trip other things, and we take a very much a worst case scenario into mind that probably is a considerably worse case than most people do. So I don't look at it as huge, and I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. it's like the virus. It strikes some people with much greater ferocity than others, and fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks, because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning or the market.
And about 4 or 5 years ago, I put most of my family's portfolio, actually all of it, into Berkshire Hathaway. And over the past 4 or 5 years, the stock price has remained rather steady, and I've withstood the year 2000 when friends were making 50% and I was losing 50% on my investment. But I have to admit, when I read your Fortune article last year and you referred to the stock price as expensive, I felt badly. Now, I spend my days sometimes having fun figuring out the value of Berkshire Hathaway. But at night, after that comment, I could also wake up in worry and fret. And I realize you talked recently a lot about the qualitative and quantitative aspects of things. And I guess I would like you, with your self-reflective position and knowing that I'm asking you to do something like maybe talking about your breathing, what went into that comment to call the stock price expensive in terms of your weights and measures? What price, what value? What do you think about the company and its stock price when you say it's expensive?
I think if you I don't remember the exact wording of that article, but I'm quite sure that I told the author of that article, and I'm almost positive it was in the article, that I said I thought it was more attractive than owning the general market or the S&P. So I was saying that I preferred it to the general market. I'm certainly happy having 99 and a large fraction percent of my net worth in it. I've never sold a share. I am not the least bit uncomfortable about holding it until the day I die, and quite a bit thereafter. But I have not thought stocks were cheap at all for some time, and I've never wanted to encourage anybody, particularly in the last few years, to buy Berkshire or any other stock, because the market, I felt that I felt we had a great bubble, and I think Berkshire's value has improved. I think Charlie does too, fairly significantly in recent years. And I would, if I had a chance to swap tax-free my Berkshire for the S&P 500 or for any mutual fund or anything, I wouldn't give it a thought. But that does not mean I think either Berkshire or stocks are cheap. Charlie?
I've got nothing to add to that.
I don't think we've ever recommended the purchase or sale of Berkshire that I can remember. We did say at one time we would repurchase shares, which has a certain underlying message to it, and we said at other times we wouldn't buy shares. That doesn't mean we'd sell shares at all, but we wouldn't have bought them under the prevailing conditions. But we've stayed away from recommending, actually, not only the purchase or sale, not only of Berkshire, but just of any other specific shares. We've only given our views occasionally on what we think about the level of the stock market generally. But I do think if you go back and look at that article, I wish I had it here, but I think you'll find that I said I preferred it to equities generally.
I do think that there's a lot to be said for developing a temperament that can own securities without fretting. I think that the fretful disposition is it's an enemy of long-term performance.
Well, I think it's almost impossible if you're to do well in equities over a period of time. If you go to bed every night thinking about the price of them, I mean, Charlie and we think about the value of them, but we would be happy, just as in that movie, if they closed the stock exchange tomorrow. Dick Grasso wouldn't be happy, and Jimmy McGuire, our specialist, wouldn't be happy. It wouldn't bother me and Charlie at all. We would keep selling bricks, selling deli bars, selling candy, writing insurance. A lot of people have private companies and they never get a quote on them. We bought See's Candy in 1972. We haven't had a quote on it since. Does that make us wonder about how we're doing with See's Candy? No, we looked at the company results. So there's nothing wrong with focusing on company results. Focusing on the price of a stock is dynamite, because it really means that you think that the stock market knows more than you do. Now, the stock market may know more than you do, but then you shouldn't be in stocks. I mean, you should have, the stock market is there to serve you and not to instruct you. So you need to formulate your ideas on price and value. And if the price gets cheaper and you have funds, logically you should buy more. And we do that all the time. Where we make our mistakes, frankly, is where we focus on price and value and we start buying and the price goes up a little and we quit. Like Charlie referred to, we might have done on See's Candy. A mistake like that cost us $8 billion in the case of Walmart stock a few years ago, because it went up in price. And we are not happy when things we're buying go up in price. We want them to go down and down and down, and we'll keep buying more. And hopefully we won't run out of money. Of course, that's a different story.
Many Chinese investors feel all kinds of performance pressure, question, and even laughing at value investing. Many also believe that value investing does not apply to China, where the stock market just doubled over the last 6 months. I would like to ask Mr. Buffett, do you think value investment can be widely applied in all markets, or just for mature markets, just as the ones in the United States? Do you have any suggestions for value investors to hold against pressure and to be much happy? Thank you.
Okay, I'm not sure I got all of it, but Charlie will help me. I certainly think investment principles do not stop at borders. So if I were investing in China or any place else, India, UK, Germany, I would apply exactly the same sort of principles that I learned from the intelligent investor. I would think of stocks as a small piece of a business. I would think of investment fluctuations being there to benefit me rather than to hurt me. And I would try to focus my attention on businesses that where I thought I understood the competitive advantage they had and what they would look like in 5 or 10 years. So I don't think I would change the principles at all. I'm not sure I got all of the question. Maybe Charlie can elaborate on the rest.
Well, the Chinese have a history of being very entrepreneurial and of gambling very heavily when they have the opportunity. And it has created great volatility in the Chinese stock markets. And when things get bouncy and prosperous like our internet craze here in the United States, China looks a lot like Silicon Valley. I think China would do way better to be more value investor minded and less absorbed in waves of speculation. So I think the more China copies the way Berkshire operates, I think the better it'll be for China.
Yeah, there's a certain irony in that we would do the best over decades if we operated in a market where people operated very foolishly. And the more people respond to short-term events and exaggerated things or anything that causes people to get wildly enthusiastic or wildly depressed actually is what allows people to make lots of money in securities. And on the other hand, it's not the greatest thing for a society. And Charlie and I have benefited enormously by the fact that over a 50-year period, there have been a few periods Probably the most extraordinary being 1973 and 74, where you could buy stocks unbelievably cheap, cheaper than happened in 2008 and 2009. And, you know, it doesn't make sense to have that much volatility in the market, but humans behave the way humans behave, and they're going to continue to behave that way in the next 50 years. I mean, if you're a young investor and you can sort of stand back and value stocks as businesses and invest when things are very cheap, no matter what anybody is saying on television or what you're reading, and perhaps, if you wish, sell when people get terribly enthused, it is really not a very tough intellectual game. It's an easy game if you can control your emotions. And as Charlie says, that he thinks, we've talked about a little bit, that the Chinese market may be more, there may be more speculative influences in it even than in the United States, because it's a relatively new development and it may lend itself to greater extremes. And that should produce great opportunities. Charlie?
Yeah, well, there are great opportunities for excess and nasty contractions after unnatural booms and so on. I think China is wise to dampen the speculative booms, and I think the Chinese, I don't think the value investing will ever go out of style. Who in the hell doesn't want value when you buy something? How can there be anything else that makes any sense except value investing?
It never gets that popular, though.
People are looking for an easier way, and that's a mistake. It looks easier, but in fact it's harder. And there's a lot of misery to be obtained by misusing stocks.
Yeah, nobody buys a farm to make a lot of money next week or next month, or they buy it, an apartment house. They buy it based on what they think the long-term future is, and if they make a reasoned calculation of that and the purchase price looks attractive, they buy it, and then they don't get a quote on it every day or every week or every month or even every year. And that's probably a better way to look at stocks.
Question: are you concerned about the rising valuations on the NASDAQ market, where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they trade at 10 times revenues or more, 30 times revenues, instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that, because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced, and phony stock promotions, and the gullible being led into to believe in things that just can't come true. So that's always gone on. It always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. And it really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years. But it's very tough to make money being short them, although we tried a few times way back. We don't look at indicia from stocks in general, or from PEs or price sales ratios, or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola? The 8% we own of Coca-Cola, the 11% of Gillette, if they said we're just going to delist the stock and we're never going, we'll open it again in 20 years. It's fine with us, and then if it goes down on the news, we'll buy more of it. So we care about what the business does. Yeah.
Thank you, sir. The second part of my question is this: given your assumptions on gold, if you were to factor a significant decline in the value of the dollar against gold, let's say 40% or more, and given the correlation of 1929-48 and 64-81 eras positively to decline of the dollar, and the negative correlation in the other two areas that you had studied, would you care to adjust the 7% total annual return you were quoted as expecting for common equity in the coming decade? And in conjunction with that, would you care to comment on your expected rate of return on all other major asset classes, perhaps like bonds, real estates, and which would you believe offers the best value for investors?
Yeah, well,
thank you very much.
Except under unusual circumstances, my expected rate, my expectancy on something like bonds is what bonds are producing at a given time. I don't think I'm smarter than the bond market. Now you can say when those rates swing all over, does that mean I swing all over? The answer is pretty close to yes. I mean, I don't know what the right rate for bonds is. I think that if there's, I'm very leery of economic correlations. I mean, I spent years fooling around with that sort of thing, and I mean, I correlated stock prices with everything in the world, and the problem was when I found a correlation. I mean, it's you've seen these things on whether the AFC or the NFL wins the Super Bowl and all that sort of thing. You can find something that correlates with something else, but in the end, a business or any economic asset is going to be worth what it produces in the way of cash over its lifetime. And if you own an oil field, if you own a farm, if you own an apartment house, with the oil field, it's the life of the oil field and what you can get out of it. And maybe you get secondary recovery, maybe you get tertiary recovery, but whatever it may be, it's worth the discounted value of the oil that's going to come out. And then you have to make an estimate as to volume and as to price. With a farm, you make an estimate as to crop yield and costs and crop prices. And the apartment house, you make an estimate as to rentals and operating expenses and how long it'll last and when people will build other new apartment houses that potential renters in the future will find preferable and so on. But all investment is laying out some money now to get more money back in the future. Now, there's two ways of looking at getting the money back. One is from what the asset itself will produce. That's investment. One is from what somebody else will pay you for it later on, irrespective of what the asset produces, and I call that speculation. So if you are looking to the asset itself, you don't care about the quote because the asset is going to produce the money for you. And that's what society as a whole is going to get from investing in that asset. Then there's the other way of looking at it is what somebody will pay you tomorrow for it, even if it's valueless. And that's speculation. And of course, society gets nothing out of that eventually, but one group profits at the expense of another. And of course, you had that operate in a huge way in the bubble of a few years ago. You had all kinds of things that were going to produce nothing, but where you had great amounts of wealth transfer in the short term. As investments, they were a disaster. As means of wealth transfer, they were terrific for certain people, and they were for the other people that were on the other side of the wealth transfer. They were disasters. We look solely. We don't care whether something's quoted because we don't buy it with the idea of selling it to somebody. We look at what the business itself will produce. We bought See's Candy in 1972. The success of that has been because of the cash it's produced subsequently. It's not based on the fact I call up somebody at a brokerage house every day and say, what's my See's Candy stock worth? And that is our approach to anything. On interest rates, I'm no good. I bought some REITs a couple of years ago because I thought they were undervalued. Why did I think they were undervalued? Because I thought they could produce 11 or 12% in terms of the assets that those companies had, and I thought an 11 or 12% return was attractive. Now the REITs are selling at higher prices, and they're not as attractive as they were then. But you just look at every asset class, every business, every farm, every REIT, whatever it may be, and say, what is this thing likely to produce over time? And that's what it's worth. It may sell at vastly different prices from time to time, but that just means one person is profiting against another, and that's not our game.
My question is on what key steps would you recommend to correct the mindset of typical investor like me which is what you narrate as lemmings-like, the crowd mindset.
What would we recommend? We got the question being repeated here. About the mindset of an investor, is it?
He wants you to advise him as to how he can become less like a lemming.
Well, since you repeated the question, I'm going to let you give the first answer to that, Charlie. Until he eats about 1,000 calories a day.
He wants to invest less like a lemming.
Oh, I understand that. I was giving you the first shot at it, but I will tell you what changed my own life on investing. I started investing when I was 11. I first started reading about it. I believe in reading everything in sight, and first started reading about it when I was probably 6 or 7 years old. But for about 8 years, I wandered around with technical analysis and doing all kinds of things, and then I read a book called The Intelligent Investor. And I did that when I was 19 down at the University of Nebraska. And I would say that if you absorb the lessons of The Intelligent Investor, mainly, and I wrote a foreword and I recommended particularly chapters 8 and 20, that you will not behave like a lemming, and you may do very well compared to the lemmings. We have here in the bookworm copies of The Intelligent Investor, and I think it's as great a book now as I did when I read it early, I guess, in 1950. You can't get a bad result if you follow the lessons of Ben Graham taught in that book. I should mention that there's a book out there also that I did not know it would be completed by this time. My cousin Bill Buffett has written a book about our grandfather's grocery store called Food You Will Enjoy, and Bill will be out there. He's signing books. I just got my first copy a couple of days ago, read it, and I enjoyed it a lot. Charlie worked at the same grocery store. How many years ago? Probably a good 70 years ago in Charlie's case. Neither one of us was very good. But my grandfather, you don't want to pay much attention to his advice on stocks. He wrote a lot of letters, and he was very negative on the stock market and big on hard work at the grocery store, so we quit listening to him. Instead, read The Intelligent Investor. That's the book that gave me a philosophy that has taken me now for a lot of years, and there's 3 big lessons in there which relate to your attitude toward stocks generally, which is that you think of them as parts of a business, and your attitude toward the market, which is that you use it to serve you and not to instruct you, and then the idea of a margin of safety, of always leaving some extra room in things. But the people in this room, I think, have learned that important first lesson. I mean, I think most people that own Berkshire do not see themselves as owning something with a little ticker symbol or something that may have a favorable or unfavorable earnings surprise or something of the sort, but they rather think of themselves as owning a group of those businesses that are out there in the other room. And that's the way to look at stocks. You'll never be a lemming if you do that.
It appeared to me that in 1993 the variation between the stock price for the high and the low was much greater in years in the past. Would you mind commenting on that?
Well, there was more volatility in the price of Berkshire last year, and as I put in the annual report, the stock overperformed the business last year. Now, over any 10 or 20 or 30-year history, every year the stock is going to perform a little differently, at least, in the business. I mean, it may slightly underperform or slightly overperform. We would prefer that those variations be as small as possible, but there was more variability last year than historically has been the case, although we've had we've had a few years like that. Our best way to handle that is to give all the information we can to shareholders and prospective shareholders and follow policies that we think will induce the investment oriented with long time horizons to join us and not to encourage other people. But occasionally, we can't guarantee that result. One of the things that was interesting to me, I don't know whether it was 3 months ago or when, but I happened to be talking to the specialist, terrific specialist, Jimmy McGuire. He had to leave, but he was here earlier in the session. And I think at the time the stock was around 16,000 or something like that. And he had some rather significant stop loss orders on the books at 15.5 or thereabouts, involving some hundreds of shares. And that, to me, is a signal that, we have some people that are, in my view, are not really the kind of owners that we would like to attract, because why somebody wants to put in an order to sell something for 15,500 that they don't want to sell at 16,000 is beyond me. But the idea of people using stop loss orders with Berkshire, obviously, it tells me that we've got some people in that are using it as a trading vehicle of some sort, or have some totally non-investment type calculations in their mind. I don't think we have very many of them. But obviously, if we have enough people like that, you will have a more volatile stock than if you have a whole bunch of people who look at it as something that they're going to hold for the rest of their life. And the stock did go down at that time and hit 15,500, and there were I think it was close to 300 shares, which is $4.5 million worth of stock. And somebody made a decision, apparently, that or some small number of people made a decision that they wanted to sell something at 15,500 that they could have sold for 16,000. The lower it went, the better they liked it, apparently. I mean, the better they liked the sale. Which, has always struck me as like having a house that you like and you're living in, and, it's worth $100,000, and you tell your broker, if anybody ever comes along and offers 90, you want to sell it. I mean, it doesn't make any sense to me. But it has, I would say that there's been some small, I think relatively small tendency for people to get, relatively few people, but to get more interested in the price of the stock than in terms of, and thinking of it in terms of whether it's going to go up or down in the next 6 months than might formerly have been the case. I think we're unusually well blessed in that respect, in that we've got people who basically want to own it for a very long time. But to the extent that you get people who are owning it because they think the stock market's going to go up or something of that sort's going to happen, that is not good news from our standpoint, and it will increase the volatility in it. We will do nothing to encourage that.
The magic of long-term, concentrated value investing is real, yet similar to Harry Potter, the rest of the world doesn't believe we exist. Your letter to me has changed my life. And your Secret Millionaires Club has changed my children's life. They go to class chatting about investing. My question is for my children watching at home today and the children in the audience. How should they look at stocks when every day in the media they see companies that have never made a dime in their life go IPO, they're dilutive, and they see a lot of a very short-term spin. The cycle is getting shorter and shorter. How should they view stocks, and what's your message for them?
You don't have to really worry about, what's going on in IPOs or people making money. People win lotteries every day, but there's no reason to have that affect you at all. You shouldn't be jealous about it. I mean, if they want to do mathematically unsound things, and one of them occasionally gets lucky and they put the one person on television and the million that contributed to the winnings with the big slice taken out for the state, don't get on there. It's nothing to worry about. Just all you have to do is figure out what makes sense, and you look at buying. When you buy a stock, you get yourself in the mental frame of mind that you're buying a business. And if you don't look at a quote on it for 5 years, that's fine. You don't get a quote on your farm every day or every week or every month. You don't get it on your apartment house if you own one. If you own a McDonald's franchise, you don't get a quote every day. You want to look at your stocks as businesses and think about their performance as businesses. Think about what you pay for them as you would think about buying a business, and let the rest of the world go its own way. You you don't want to get into a stupid game just because it's available. And I'm going to say a little bit more about that close to the break. But with that, I'll turn it over to Charlie.
Yeah, well, I think that your children are right to look for people they can trust in dealing with stocks and bonds. Unfortunately, more than half the time, they will fail in a conventional answer. So they really have they have a hard problem. If you just listen to your elders, they'll lie to you and spread a lot of folly.
But they really have an easy problem. But in the sense that American business as a whole is going to do fine over time. So the only way that they can...
But not the average client of a stockbroker.
Well, we'll get to that later. The stockbroker will do fine.
Yes, that's true.
Yeah. But they don't have to do that, and we can talk. Well, I'd rather address that just a little later. But you don't want to worry. You don't want to be. A lot of problems are, Charlie would say, are caused by envy. You don't want to get envious of somebody who's won the lottery or bought an IPO that went up. You have to figure out what makes sense and follow your own course.
The hardest thing in this world is to change people's values or belief system. And we should like to awake investors to change from speculate in the market to investing in the market. It's like changing the speculators' values or belief system. May I ask you, Mr. Buffett, can you kindly advise us what we should do to spread your value investing philosophy, or is there any word of encouragement? Thank you.
Yeah, when in any system, Keynes wrote about this in 1936, I think it was, in the General Theory, or 35, I think it's chapter 12. It's great chapter on investing, and he talked about investment and speculation and the propensity of people to speculate and the dangers of it, and worded eloquently. There's always the possibility of, there's always some speculation, obviously, and there's always some value investors and all of that sort of thing in the market, but when speculation gets rampant, and when you're getting what I guess Charlie would call social proof that it's worked recently, people can get very excited about speculating in markets, and we will have it from time to time in this market. There's nothing more agonizing than to see your neighbor, who you think has an IQ about 30 points below you, getting richer than you are by buying stocks, and whether it's internet stocks or whatever, and people succumb to it, and they'll succumb in this economy just as elsewhere. There's also a point which gets to your question. I would say that early on in the development of markets, there's probably there's some tendency for them, I think, to be more speculative than markets that have been around for a couple of hundred years. Because markets have a casino characteristic that has a lot of appeal to people, particularly when they see, like I say, people getting rich around them. And those who haven't been through cycles before are probably a little more prone to speculate than people who have experienced the outcome of wild speculation. So basically in this country, Ben Graham was, in the book I read in 1949, was preaching investment, and that book continues to sell very well. But if the market gets hot, new issues are doing well, and people on leverage are doing well, a lot of people will be attracted to not only speculation, but what I would call gambling. And I'm afraid that will be true in the United States. And I think that that China being a newer market, essentially in which there's widespread participation, is likely to have some pretty extreme experiences in that respect. We will have some in this country too. Charlie?
Well, I certainly agree with that. The Chinese will have more trouble. They're very bright people. They have a lot of action, and sure, they're going to be more speculative. And it's a dumb idea. And to the extent you're working on it, why, you're on the side of the angels, but lots of luck.
Well, it will offer the investor more opportunities, actually, if they can keep their wits about them. If you have wild speculation, I mean, Charlie just mentioned earlier, you know, if we get into periods that are very tough, Berkshire certainly will do reasonably well because it won't, and we won't get fearful, and fear spreads like you cannot believe until you've seen a few examples of it. At the start of September 2008, you had 35 million people with their money in money market funds with $3.5 trillion in them, and none of them were afraid that that dollar wasn't going to be a dollar when they went to cash in their money market fund. And 3 weeks later, they were all terrified, and 175 billion flowed out in 3 days. And so the way the public can react is really extreme in markets. And that actually offers opportunities for investors. People like action and they like to gamble. And if they think there's easy money to be made, a lot of them, you'll get a rush to it. And for a while, it will be self-fulfilling and create new converts until the day of reckoning comes. So just keep preaching, investing, and if the market swings around a lot, you'll keep adding a few people here and there to a group that recognizes that markets are there to be taken advantage of rather than to instruct you as to what is going on. Okay, Andrew, anything more on that front?
We've done a lot of preaching, Warren, without much effect.
Right. And that's probably good from our standpoint.
Mr. Buffett, in October of last year, you wrote in a New York Times op-ed piece that you were moving your personal portfolio to 100% U.S. equities. My question is that move complete? If not, are you still buying? And in addition to that, how would you rank the recent market downturn in terms of investing opportunities in stocks during your investment careers?
Well, it's certainly not as dramatic as the 1974 period was. Stocks got much cheaper in 1974 than they are now, but you were also facing a different interest rate scenario, so you could say they really weren't that much cheaper. You could buy very good companies at 4 times earnings or thereabouts with good prospects, but interest rates were far higher then. That was the best period I've ever seen for buying common equities. The country may not have been in as much trouble then as we were back in September. I don't think it was, but stocks were somewhat cheaper then. In the recent period, I bought some equities, and then corporate bonds looked extraordinarily cheap. The spreads were very, very wide, so I bought some of those too. But the cheaper things get, the better I like buying them. I mean, if I was buying hamburgers at McDonald's, the other day for X, and they reduced the price to 90% of X tomorrow, not likely, but if they did, I'm happy. I don't think about what I paid yesterday for the hamburger. I think I'm going to be buying hamburgers the rest of my life, and the cheaper they get, the better I like it. I'm going to be buying investments the rest of my life, and I would much rather pay half of X than X. And the fact that I paid X yesterday doesn't bother me if I get it, as long as I know the value is in the business. So on a personal basis, I like lower prices. I realize that is not the way all of you feel, and that when you wake up in the morning and look at quotes, but it just makes sense that when things are on sale, that you should be more excited about buying them than otherwise. And lately, when I wrote that article at the Times, I did not predict what stocks were going to do because I never know what they're going to do. But I do know when you're starting to get a lot for your money, and that's when I believe in buying. Charlie?
Well, if stocks go off 40% on average, they're obviously closer to an attractive price than they were before. And of course, interest rates have gone down a lot recently, at least short-term interest rates. It's nothing like 73.4. No. I knew when that happened that that was my time and my only time. I knew I was never going to get another trip to the pie counter like that one. Unfortunately, I had practically no money available, which is...
That's why it happens.
That's why those times occur.
Yeah.
So, if I were you, I wouldn't wait for 1973-4.
No, we don't try to pick bottoms, or we don't have an opinion about whether the stock market's going to go tomorrow or next week or next month. So, to sit around and not do something that's sensible because you think there will be something even more attractive, that's just not our approach to it. Anytime we get a chance to do something that makes sense, we do it. And if it makes even more sense the next day, and if we've got money, we may do more. And if we don't, what can we do about it? So picking bottoms is basically not our game. Pricing is our game, and that's not so difficult. Picking bottoms, I think, is probably impossible. But when you start getting a lot for your money, you buy it. And as I say, after I wrote that, stocks did get cheaper. Corporate bonds, the corporate bond market got very, very, very disorganized. And we bought some fairly good sized pieces of bonds for Berkshire, and I also bought a few little things for myself. But I spend 99% of my time thinking about Berkshire. That's
Warren, by now, don't we have our small life insurance companies pretty well full of desirable debt instruments at 10%?
We certainly got a lot more of it than we had. Yeah, no, we got a chance to buy some corporate bonds very, very cheaply, at least in my view, a few months back, and we had money in life companies that can't be used in certain other areas, and for which this was an ideal time to just barrel in. And anytime we like to do something, we really like to do it. I mean, our idea is not to tiptoe into anything, so we buy them as fast as we can when prices are right.
Yeah, that bond thing didn't last very long.
No.
But there were perfectly safe bonds that yielded 9% or more with very fancy call protection.
Yep.
And some of those bonds are up 20-25%.
Yep.
So the opportunities are frequently under shell A when you're looking at shell B.
Yeah, we try to look at all the shells.
Yeah, we look at all the shells. Right?
Yeah. Yeah. Well, I won't comment on the three companies that you've named, but in general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in
in the throes of some panic, you know, that you'd sort of take the attitude of a mortician, you know, waiting for a flu epidemic or something. I mean, I'm not sure I'm not sure will be a great technique. I mean, it may be great if you inherit it. You know, Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but yeah. It's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and you know, if you start with the Dow at X and you think it's too high, you know, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you know, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. You'll probably learn a lot more with him by coming to this meeting. But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, you know, my brother just died and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and the price looks a little high maybe, but this is what I think I can get for it. You know, do you want to buy in?" You know, I think if you like the business and you like the person who's coming to you and the price sounds reasonable and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month. You know, I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened, I mean, we did well back in 1964 because American Express ran into a crook. You know, we did well in 1976 because Geico's managers and auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.
You've already hinted about Coke and Gillette's current valuations and also about their great prospects for the future. But in the past year, both stocks have been down 30 to 50% from their highs. How much farther would they have had to fall before your criteria of margin of safety been satisfied and allowed you to purchase more shares? And two, has the Disney Cap Cities merger gone as well as you would have hoped? And has the future prospects of Disney changed in your opinion?
First question, that's a good question on Coke and Gillette, because obviously we think about the businesses that we're the most familiar with and where we're committed. That neither one of those businesses got to the price that left us happy putting new money in, but we're quite happy, very happy owning those businesses, and we'll be happy owning them for a very long time to come. But it's some evidence of where the market has been and is that even when they ran into some tougher business conditions than they anticipated, that their stocks did not get down to the prices that caused us to get excited about them. Charlie, you want to comment on that, or the second part?
Well, no, but I do want to remind people that the Dilly Bar is a Dairy Queen product.
Mm-hmm. And they are good, I can tell you that.
I wouldn't want the shareholders to believe that the commercial standards of this operation are faltering. generally speaking, trying to dance in and out of the companies you really love on a long-term basis has not been a good idea for most investors. And we're quite content to sit with our best holdings.
People have tried to do that with Berkshire over the years, and I've had some friends that thought it was getting a little ahead of itself from time to time, and they thought they'd sell and buy it back cheaper and everything. It's pretty tough to do. You have to make two decisions right. You know, you have to sell it right first, and then you have to buy it right later on, and usually you have to pay some tax in between. If you get into a wonderful business, best thing to do is to stick with it. Coke and Gillette both experienced disappointments to their management below what they anticipated a year and a half ago or whenever it was, and below what we anticipated. But that will happen over time. It happens with some of our wholly owned businesses from time to time. Sometimes they do better than we anticipate too. But it's not the nature that everything goes in a nice straight smooth line upward. You mentioned Cap Cities. Parts of Cap Cities have done extraordinarily well, for example. But in the network business, if you go back 30 years and look at what network has been on top, you find that no one stays on top or on the bottom indefinitely. It's a competitive world, as I mentioned earlier, and sometimes your competitors' correct moves, your own incorrect moves, the world environment, all of those things can interrupt trend lines. I see nothing that's happened in the last year in terms of the long-term trend line of the blade and razor business, which is the one I referred to as inevitable at Gillette. I mean, there are other businesses that are not in the same category as the blade and razor business. Coke, fortunately, has virtually its entire business in soft drinks, and so it comprises almost 100% of the whole there. But I see nothing that would change my thinking about the long-term future of either the blade and razor business or Coke's position in the soft drink business.
You have both talked today about the shrinking universe of stocks you could purchase, less margin of safety than ever, and a higher opportunity cost. And you've also talked about looking to potentially purchase your great companies that you already have at reasonable prices. And so I wonder if by talking so positively about some of your stocks, in particular Disney, such as in the 95 annual report when you talked about actually telling everyone that you were buying more shares on the open market, and again at the 97 meeting, at their meeting when you talked about maybe not selling the shares, those were both opportunities maybe when Disney may have dropped because of such things as increased debt or even people's concerned about the Ovitz compensation package. And I just wonder if that may hurt your ability to buy these great companies at reasonable prices by talking so positively about them when in fact maybe you could buy them at lower prices when people get irrational.
Yeah, you're saying that, which I probably agree with, that if we would say the world is going to hell at Coke or Disney or Gillette, we might be better off in terms of being able to buy more stock. But you know, I got asked a question at Disney and I answered it, and that's my general approach. That I think it's usually a bad mistake to sell your interest in wonderful businesses. I don't think people find them that often, and I think they get hung up if they've sold them at X that they want to buy them back at 90% of X or 85% of X, so they'll never go back in at 105% of X. So I think on balance, if you are in a business that you understand and you think it's a really outstanding business, that the presumption should be that you just hold it and don't worry. And if it goes down 25% in price or 30% in price, if you have more money available, buy more, and if you don't, so what? Just look at the business and judge how it's doing. But there's no question. I mean, we try not to talk very much about the businesses, except maybe to use them as an illustration in a teaching mode or something of the sort. We're not touting anything, and I did try to stick those precautions in when I do talk about them as being wonderful businesses, so people don't take it as an unqualified buy recommendation or something of the sort. But we won't try and put any spin on when we're talking about business generally. We may not talk about them at all. If we're buying something, we might be, that particularly if no one knows that we've been in that stock at all, we might be somewhat quiet about the fact, but we don't want to talk down something in order to buy it. Charlie?
Jerry Newman, as I understand it, didn't like Ben Graham giving all these courses explaining what Newman and Graham were doing. But Graham's attitude was that he was a professor first, and if he made just slightly less money by being very accurate in what he taught, why, so be it. And I think it's fair to say that Warren has assimilated a bit of that ethos. And I think it's all to the good. And if it costs us a tiny little bit of money from time to time, there are probably compensating benefits. And if there aren't, it's probably the right way to behave anyway.
Charlie, if you were in a less charitable mood, might point out I didn't behave that way till I got rich. Actually, I used to teach a course at what was then the University of Omaha, and we used all these current examples, and things were so cheap there, but nobody paid any attention.
Earlier this morning, you made a comment that if the market fell, you would be spending less time on the internet because you'd be very busy. And this has reinforced an impression I have had that the cash flows of Berkshire Hathaway are enormous, but that possibly in the last 12 months, you've been investing less than you had previously. And if so, if this is correct, what does that say about waiting for attractive values? How long are you willing to wait? And what does that say to the investment public in their own habits?
Well, you're correct that we have not found anything to speak of in equities in a good many months. And the question of how long we wait, we wait indefinitely. We are not going to buy anything just to buy something. We will only buy something if we think we're getting something attractive. And incidentally, if things were 5% cheaper, or 10% cheaper, that wouldn't change anything materially. So we have no idea when that period ends. We have no idea whether, as I've said, it can turn out that these valuations are perfectly appropriate if returns on equity stay where they are. But they are, even then, they aren't in the least mouth-watering. So we won't feel we've missed anything particularly if returns stay where they are, because if it turns out that these levels are okay, they still will not produce great returns from here in our view. That doesn't mean you couldn't have a tremendous market in the short term or something of the sort. Markets can do anything. I mean, you look at the history of markets and you just see everything under the sun. But we will not, we have no time frame. If the money piles up, the money piles up, and when we see something that makes sense, we're willing to act very fast, very big, but we're not willing to act on anything that doesn't check out in our view. You don't get paid for activity, you only get paid for being right. Charlie?
Yeah, an occasional dull stretch for new buying, this is no great tragedy in an investment lifetime. And other things may be possible in such an era too. I mean, it isn't like we have a quiver with only one arrow.
We sat through periods before. I mean, the most dramatic one being the early 70s, late 60s and early 70s. For a long time, it doesn't seem so long when you look back on it. It seems long when you're going through it, but it's like having a tooth pulled or something. But it's, what can you do about it? The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like. We'll love it when we can swing in a big way, though. That's our style.
You've touched on some of this already today, but I wanted to ask if you could expand on how you think about comparing investment opportunity. In the past, you haven't been afraid to make a single position a large portion of your portfolio, such as Coca-Cola. So when there is a chance to buy more of your favorite names, as in 2008 and early 2009, how did the case of buying more of companies like Coca-Cola or even a Moody's, which had dropped from 75 to 15 as examples, compare with other things that you actually did? Could Berkshire have achieved its historical returns with a more simple, concentrated portfolio of your favorite names with positive characteristics such as durable competitive advantage, pricing power, strong organic growth, etc., versus the larger, more complex collection of businesses which exist today? Thank you.
Well, depends which favorite name we might have hit harder back in the 2008 and 2009 period. In the first instance, I spent a considerable part of our cash reserves too early, looking back, too early in the 2009 panic. The bottom of that was reached early in March in 2009, and that bottom was quite a bit lower than September and October of 2008, when we spent 16 or so billion. Now, we were committed to finance Mars for $6.6 billion, and that commitment had been made many months earlier, so we didn't really have much choice in terms of the timing of that. But we did fine on the expenditures we made during that period, but obviously we didn't do as well, remotely as well, as if we'd kept all of the powder dry and then just spent it all at once at the bottom. But we've never really figured out how to do that, and we won't figure out how to do that. So the timing could have been improved dramatically. On the other hand, as late as the late fall of October 2009, when the economy was still in the dumps, really in the dumps, we were able to buy BNSF, which will be an enormous part of our future. So overall, we did reasonably well going through that period, but looking back, the most money would have been made just by buying a bundle of stocks. When we were buying Harley-Davidson bonds at 15, looking back, we should have been buying the stock, but that'll always be the case.
I was just wondering, there's a lot of differences between the recent boom and bust in the stock market and the one in the 1920s, but there's also a lot of similarities, and those similarities are allowing people to draw the conclusion that stock prices will be depressed for some time to come. Where do you disagree and agree with that conclusion?
Well, the whole century is quite interesting. If you take the 20th century, it was an unbelievable century for the United States. The GDP per capita, and that's the way to think of it, as per capita. Sometimes they talk about our GDP versus Europe's, but if their population's the same every year and ours goes up 1%, you've got to, in the end, you got to have a divisor as well as a numerator. And so GDP per capita in the 20th century in the United States went up 610%. Actually, qualitatively, it went up far more than that, because you can't really measure certain things in medicine or whatever it may be, and improvements. But just on a quantitative basis, it went up every single decade, including the decade of the 30s. So here you had 100 years when basically the U.S. citizenry was improving their lot decade by decade by decade. The 30s, it was up 13%. Best decade was World War II. The 40s, it's up 36%. The worst decade was the First World War. So you get sometimes the analogy, you can get in trouble on analogies. But in any event, it was a huge period. Interestingly enough, there were 6 big periods in there for the stock market in both directions. There were 3 big bull markets. From 1900 to 1921, the Dow went from 66 to 71, less than a 10% move in 20 years, less than 0.5% a year. You got dividends too, but 0.5%. So it didn't move. From 21 to 29, as you point out, it went from 71 to a high of 381 in September of 1929. Went up 500%. Well, obviously, the well-being of the country didn't go up 500% during that period. And the well-being of the country went up a whole lot more than 10% during that first 21 years. So you got this very uneven development. Then from September 1929 until the end of 1948, the Dow went from 381 to about 180. It was cut in half. And that was 18 long years.
And yet the per capita GDP was moving right up during this whole period. So the economy was doing fine. From 48 to 65, the Dow went again from about 180 up to close to 1,000. Again, 5 for 1, which was far outstripping it. From 65 to 81, the Dow went down, literally. Well, again, per capita GDP. And then we've had this last period where it's gone up terrifically. If you take the whole 100 years, it went up 180 for 1. Every $1,000 became 180,000. But 43 and 3/4 years were those 3 big, huge bull markets, and 56 and 1/4 years were periods of stagnation. All in an economy that was doing fine, you know, year after year after year. 56 and 1/4 years, net, the Dow was down a couple hundred points during that period, and the other 43 and 3/4 years made up the rest of this move from 66 to 11,000 some on the Dow. So you say to yourself, how could it be that you could have a country that was doing better and better and better and better? Citizens were living, every generation was living better than the one that preceded it. But you had these huge changes. Big gains a few times, long periods of stagnation. 20 years, I mean, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, you know, or the neighbor says, you know, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding. But that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 48, from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. You know, I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. I mean, he's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. I said, Mr. Moose, I said, you know, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, you know, a 2% investment on, and you can get 35% on your money. And he said, you know, stocks aren't any good. And I couldn't sell you, you know, I was a lousy salesman. I mean, well, you have to start with that. But it just blew me away. It blew me away. I thought, sometimes I used to wonder if I was nuts, you know. But those things, the same thing happened. I mean, in
64. The Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, people were living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now, that seems pretty... but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, and your neighbors made money or something. You've got to be... You just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy. And of course, it's fun. I mean, it's like that sign they put in brokerage offices that says, avoid hangovers, stay drunk. I mean, it's just so much fun to keep playing. But you got to do sensible things to get good results.
We may get asked, and we don't know the questions, but we may get asked, about Fed policy or whether we're seeing any inflation or whether business is speeding up or down or the threats we may face competitively in our businesses as we go along. And anything goes on the questions, except we won't tell you what we're buying or selling. But it really can be a question sometimes of confusing the forest with the trees. And I would like to just spend just a couple of minutes giving you a little perspective on how you might think about investments as opposed to the tendency to focus on what's happening today or even this minute as you go through. And to help me in doing that, I'd like to go back through a little personal history and we will start. I have here a New York Times of March 12th, 1942. I'm a little behind on my reading. And if you go back to that time, it was just about 3 months since we got involved in a war which we were losing at that point. The newspaper headlines were filled with bad news from the Pacific, and I've taken just a couple of the headlines from the days preceding March 11th, which I'll explain. It's kind of a momentous day for me. And so you can see these headlines. We've got slide 2 up there, I believe. We were in trouble, big trouble, in the Pacific. It was only going to be a couple months later that the Philippines fell, but here we were getting bad news. We might go to slide 3 for March 9th. I hope you can read the headlines anyway. The price of the paper is 3 cents, incidentally. Let's see, we've got March 10th up there, a slide. I want to get to this advanced technology of slides. I want to make sure I'm showing you the same thing that I'm seeing in front of me. So anyway, on March 10th, the news was bad. Full clearing path to Australia. And it was like, the stock market had been reflecting this. And I'd been watching a stock called City Service Preferred Stock, which had sold at $84 the previous year. It had sold at $55 the year before, early in January, 2 months earlier. And now it was down to $40 on March 10th. So that night, despite these headlines, I said to my dad, I said, I think I'd like to pull the trigger. And I'd like you to buy me three shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. Well, let's take a look at what happened the next day. Let's go to the next slide, please. And it was not a good day. The stock market, the Dow Jones Industrials broke 100 on the downside. Now they were down 2.28%, as you see, but that was the equivalent of about a 500-point drop now. So I'm in school wondering what is going on, of course. Incidentally, you'll see on the left side of the chart, the New York Times put the Dow Jones Industrial Average below all the averages they calculated. They had their own averages, which have since disappeared, but the Dow Jones has continued. So the next day, we can go to the next slide, and you will see what happened. The stock that was at 39, my dad bought my stock right away in the morning because I'd asked him to, my 3 shares. And so I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37, which was really kind of characteristic of my timing in stocks that was going to appear in future years. But it was on what was then called the New York Curb Exchange, then became the American Stock Exchange. But things, even though the war until the Battle of Midway looked very bad, and if you'll turn to the next slide, please, you'll see that the stock did rather well. You can see where I bought it, 38 and a quarter. And then the stock went on actually to eventually be called by the City Service Company for over $200 a share. But this is not a happy story, because if you go to the next page, you will see that well, as they always say, it seemed like a good idea at the time. So I sold. I made $5 on it. It was again typical of behavior. But when you watch it go down to 27, it looked pretty good to get that profit. Well, what's the point of all this? Well, we can leave behind the City Service story, and I would like you to again imagine yourself back on March 11th of 1942. And as I say, things were looking bad in the European theater as well as what was going on in the Pacific. But everybody in this country knew America was going to win the war. I mean, it was, we'd gotten blindsided, but we were going to win the war, and we knew that the American system had been working well since 1776. So if you'll turn to the next slide, I'd like you to imagine that at that time you had invested $10,000 and you put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500. Now I would like you to think a while, and do not change the slide here for a minute. I'd like you to think about how much that $10,000 would now be worth if you just had one basic premise. Just like in buying a farm, you buy it to hold throughout your lifetime and you look to the output of the farm to determine whether you made a wise investment. You look to the output of the apartment house to decide whether you made a wise investment if you buy an small apartment house to hold for your life. And let's say instead you decided to put the $10,000 in and hold a piece of American business and never look at another stock quote, never listen to another person give you advice or anything on the sort. I want you to think how much money you might have now. And now that you've got a number in your head, let's go to the next slide and we'll get the answer. You'd have $51 million and you wouldn't have had to do anything. You wouldn't have to understand accounting. You wouldn't have to look at your quotations every day like I did that first day. I'd already lost $3.75 by the time I came home from school. All you had to do was figure that America was going to do well over time, that we would overcome the current difficulties, and that if America did well, American business would do well. You didn't have to pick out winning stocks. You didn't have to pick out a winning time or anything of the sort. You basically just had to make one investment decision in your life. And that wasn't the only time to do it. I mean, I could go back and pick other times that would work out even greater gains. But as you listen to the questions and answers we give today, just remember that the overriding question is, how is American business going to do over your investing lifetime? I would like to make one other comment because it's a little bit interesting. Let's say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you, and you'll get that constantly throughout your life. And instead you'd use the $10,000 to buy gold. Now for your $10,000 here, look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset. In other words, for every dollar you have made in American business, you'd have less than a penny of gain by buying in the store of value, which people tell you to run to every time you get scared by the headlines or something of the sort. It's just remarkable to me that we have operated in this country with the greatest tailwind at our back that you can imagine. It's an investor's haven. You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. But if you own a cross-section of America and you put your money in consistently over the years, there's no comparison against owning something that's going to produce nothing. And frankly, there's no comparison with trying to jump in and out of stocks and pay investment advisors. If you'd followed my advice, incidentally, or this retrospective advice, which is always so easy to give, if you'd follow that, of course, there's one problem about it. Your friendly stockbroker would have starved to death. And you could have gone to the funeral to atone for their fate. But the truth is, you would have been better off doing this than a very, very, very high percentage of investment professionals have done, or people have done that are active. It's very hard to move around successfully and beat really what can be done with a very relaxed philosophy, and you do not have to know as much about accounting or stock market terminology or whatever else it may be, or what the Fed is going to do next time and whether it's going to raise 3 times or 4 times or 2 times. None of that counts at all, really, in a lifetime of investing. What counts is having a philosophy that you stick with, that you understand why you're in it, and then you forget about doing things that you don't know how to do. So, let's move on to another crisis of a different sort that hit the country. And this, of course, is the 1929 crash, which led to the Great Depression. And here, the Dow Jones average, which we'll use through this, at that time, that's the one everybody paid attention to. Actually, the second most important average at that time, if you look at the papers, was the New York Times average, which has disappeared. And of course, the Standard & Poor's has probably regarded as a superior yardstick. But the Dow Jones is a perfectly adequate yardstick. And on September 3rd, 1929, the Dow Jones average closed at 381.17, and people were very happy, and buying stocks on margin had worked wonderfully. And the Roaring '20s had a good feeling to it, with the auto coming of age and the day of air travel coming along, and all kinds of new appliances, and the telephone getting wider use, believe it or not. It hadn't really caught on that much prior thereto, but the movies were coming on. It was a happy place. And then, of course, if we'll move to the next slide, we'll look at what happened in the couple of months after September 3rd. And the Dow Jones average almost got cut in half. And that was pretty impressive until we had this recent situation where in a shorter period of time, we lost about a third. But the crash, and there's a great book about it called The Great Crash by John Kenneth Galbraith. Let me interject one little plug here. There's a small business in Omaha. I hate what truncating this meeting or changing it so dramatically has done to many of the businesses in Omaha, because I think small businesses were the beneficiaries of a really, they got a lot of business with the Berkshire meeting, and they're going to get it in the future, but they suffered during a period like this, and they just had a story about the bookworm. Well, the bookworm, if you buy any books that come out of anything I recommend, think about, just put in bookworm in Omaha, and The Great Crash is a wonderful book, and John Kenneth Galbraith describes it. But I would like to get into a bit of a personal note, which will have some relevance, not too much, but some relevance to the story of the Great Depression, because in 1929, my dad, who was 26 years of age then, was employed as a security salesman by a local small bank. And he sold stocks and bonds, but he sold stocks. And when stocks fall 48%, and you were selling them to people a few months ago, you really don't feel like going out and facing those same people. So I think my dad probably elected to do, as they say now, shelter in place, which means stay at home. And there really wasn't that much in our house. We just had a small yard. It was wintertime anyway. My dad wouldn't have been puttering on the yard anyway. And there really wasn't, television wasn't there. And he and my mother got along very well. So under those conditions, if you'll turn to the next slide, I was born about 9 months later. So, but at that time, I was actually born on August 30th, but the stock market was closed that day, and so I'm using the previous day figures. But it wasn't. I didn't notice at the time that the market was closed, but the stock market had actually recovered over 20% during that 9.5 month period or thereabouts. People did not think in the fall of 1930, they did not think they were in a Great Depression. They thought it was a recession very much like had occurred at least a dozen times, although not always when stock markets were important. But we'd had many recessions in the United States over the time, and this did not look like it was something dramatically out of the ordinary. And for a while, actually for about 10 days after my birth, that view held on, and the stock market actually managed to go up all of 1 or 2% there in those 10 days. But that's the last day. Well, from that point, if you'll turn to the next slide, the stock market went from a level of 240 to 41, which was a noticeable decline because if somebody had given me $1,000 on the day I was born and I'd bought stocks with it and bought the Dow average, my $1,000 would have become $170 in less than 2 years. And that is something that none of us ever experienced. That we may have had it with one stock occasionally, but in terms of having a broad range of America marked down 83% in 2 years, and marked down 89% of the peak that was in September 3rd, 1929, was extraordinary. And so the Great Depression went on, and it lasted a very long time, but it lasted a lot longer in the minds of people than it did actually in its effects. World War II came along, and on sort of an involuntary manner, we adopted Keynesianism. We started running fiscal deficits, of course, that were absolutely huge, and took our debt up to a percentage of GDP, which we've never reached, had never reached before, and never have reached since. So we had an enormous economic recovery, but the minds of people had been so scarred, the memories. Parents told their children. 1929 became a symbol in people's minds. I mean, if you said 1929, it was like saying 1776 or 1492. I mean, everybody knew exactly what you were talking about, and it affected stock prices in a rather remarkable way, to the point, if you'll change to the next slide, it was January 4th of 1951 that the kid who was born on August 30th in 1930 had finished college before the stock market got back to where it was at that earlier time. So take the years from 1930, or 1929, really, to 1951, or take the year from my birth, 20 years, and bear in mind that, the country was only 140 years old when this started. That's 20 years out of this amazing 231-year lifetime of our country that was flat out, a time for a long time of no economic growth and no feeling by people in terms about the wealth of the country, about what the American economy was worth, what all these corporations that were doing far, far, far better than they were long ago. But it took all of that time to restore in the market a price level that was equal to what it was when I was born 20 years earlier. So if you think about the fact that we're enduring a few months, and we'll endure many more months, but and we don't know how it comes out. And people in the 30s didn't know how it was going to come out, but they endured, persevered, prospered, and the American miracle continued. But it's interesting in that I actually don't have a slide for the next one, because last night I was thinking, after all the slides had been prepared, I was actually thinking about this a little bit, and I remembered that at the start of 1954, the stock market the Dow was only at about 280. And I remember 1954 because it was the best year I ever had in the stock market. And the Dow went from essentially 280 or thereabouts at the start of the year to a little over 400 at the end of the year. And when it went to 400, when it crossed 381, that famous figure from 1929, when it went to 400, this will be hard for some of you to believe, but everybody wondered, is this 1929 all over again? And that seems a little far-fetched, because it was a different country in 1954. But that was the common question, and it actually achieved it achieved such a level of worry about whether we were about to jump off another cliff, just because the 381 of 1929 had been exceeded, that they held Senator Fulbright, Bill Fulbright of Arkansas, who became very famous later in terms of the Foreign Relations Committee, but he headed the Senate Banking Committee, and he called for a special investigation, and he called it the stock market study. But it really, if you read through it, he really was questioning whether we had built another house of cards again. And on his committee, it's interesting to see the Senate Finance Committee. One of the members was Prescott Bush, the father of George H.W. Bush, grandfather of George W. Bush, and had some illustrious names. And his committee, in March of 1955, with the Dow at 405, assembled 20 of the best minds in the United States to testify as to whether we were going crazy again, because the market was at 400, the Dow was at 400, and we'd gotten in this incredible trouble before. But that was the mindset of the country. It's incredible. We didn't really believe America was what it was. And my boss, the reason I'm familiar with this 1,000-page book that I have here, I found it last night in the library and everything, was that I was working in New York for one of the 20 people that was called down to testify before Senator Fulbright. And he testified right before Bill Martin, who was running the Federal Reserve, testified, and right after General Wood, who was running Sears, testified. Sears was very, very important then. And Bill Martin, of course, is the fellow that the longest running chairman in the history of the Fed, and he's the one that gave the famous quote about the function of the Fed was to take away the punch bowls just when the party started to get really warmed up. But Ben Graham, my boss, sent me over to the public library in New York and to gather some information for him. Something you could do in 5 minutes with a computer now, and I dug out something, and he went to testify. And on page 545 of this book, I knew where to look. I didn't have to go through it all, but he had the quote which I remember, and I remember because Ben Graham was one of the three smartest people I've met in my life, and he was the dean of people in securities business. He wrote the classic security analysis book in 1934. He wrote the book that changed my life, The Intelligent Investor, in 1949. He was unbelievably smart. And when he testified, the Dow at 404, he had one line in there right toward the start in his written testimony, and he said, the stock market is high. It looks high. It is high, but it's not as high as it looks. But he said it is high. And since that time, if we'll turn to the next slide, of course, we felt the American tailwind at full force, and the Dow, let's see, when the Dow went down Friday, but when we made the slide, it was about 24,000. So you're looking at a market today that has produced $100 for every dollar. All you did was had to believe in America and just buy a cross-section of America. You didn't have to read the Wall Street Journal. You didn't have to look up the price of your stock. You didn't have to pay a lot of money in fees to anybody. You just had to believe that the American miracle was intact.
Mr. Market is valuing Dow Jones at above 7,000 and S&P at above 800. By your valuation model, at the current interest rate and current inflation rate and current growth rate, what is the fair valuation of both these companies?
Yeah. Well, that's a good question, but a tough question. But I would say that if you believed the American business in aggregate could earn the kind of returns on equity that they have been earning in the last, or it has in the last couple of years, and then you postulate no change in interest rates, you can justify 7,000 on the Dow and 800 on the S&P. Now, you know, there's a couple ifs I threw in there, and if interest rates go higher, the valuation goes down automatically. And more importantly, if the returns on equity of American industry, which are at historic highs, and which sort of classical economics would tell you would be hard to maintain, if those returns go down on average, that also would pull it down. But if you're willing to accept the current level of returns on equity as being typical of the future case for American business, and you're willing to assume present interest rates are lower, then you can justify a valuation on the Dow and S&P. And it's interesting, because I got all that commentary after I wrote that line in the report, which was, as I said earlier, designed for a little something else. I'll give you a little trivia quiz. What 2 years in this century has the Dow had the greatest overall gain? The 2 years in the 1900s are 1933, which most of you don't think of as a banner year, but and 1954. And in both of those years, the Dow was up over 50%, counting dividends. In March of 1955, because of that, the fact that the Dow had gone up, bear in mind that the high on the Dow was 381 in 1929, and it took 25 years before that was surpassed. And in 1954, the Dow went from, say, 280 up to 404, or something like that, just a little over 50%. So what did they decide to do? They decided to have congressional hearings about it. And they did. In March of 1955, they had hearings in the Senate Banking and Currency Committee, Chairman Fulbright, and my boss, Ben Graham, was called down to testify. And it's fascinating reading. Bernard Baruch was there, all kinds of people. I've got the hearings at home. And Ben's opening comments about the market at that time, where the market looks high, it is high, but it's not as high as it looks. Well, that's about the present situation. I mean, it looks very high just by comparing 7,000, certainly to the 404 at the end of 1954 when Ben was testifying. But there have been huge changes in earnings and return on equity on American business in general, and then you've had this big move in interest rates. Now, those are underlying fundamentals that have powered a huge bull market. After a while, as I mentioned earlier, people get captivated simply by the notion of rising prices without going back to the underlying rationale, and that's when you get very dangerous conditions in terms of possible bubbles. And it would, I have no idea where markets will go, but you have the kind of conditions that could cause real excesses, just like you had excesses in 1973 and 4. Going back to when you could buy things at 20 cents on the dollar, you had excesses in the other direction. The country didn't disappear or anything. It's just people behave in extreme ways in markets. And over time, that's very good for people that keep their heads.
And I would like to know how much you attribute the gains enjoyed by the stock market these past years to the baby boomer generation investing for their retirement.
Yeah, I would say that personally, I would not think that has much to do with it. I think the two big factors well, there's three big factors. One is the improved return on equity, which was a fundamental factor that pushed stock prices up. Two is the decline in interest rates that pushed stock prices up. And then finally, stock prices advancing themselves brings in buying. It doesn't go on forever, but it creates its own momentum to some extent if you have these underlying factors that started to push it along. So I would say two of the three factors are fundamental, and the third is a market type factor that bull markets do feed on themselves. And I think that you've seen some evidence of that. But I don't think that any specific, the 401k factor or whatever it may be was it by itself. But I do think money is pouring into mutual funds, for example, because people have had a very favorable experience with those funds, and that does bring investors along. People want to be on the train. Charlie? And I think, incidentally, many of them have very unrealistic expectations.
Yeah, the general investment experience in the last, 18 years in common stocks has been awesomely high, I think, by any past standards now. Isn't that right, Warren?
Right. Well, you've had, since 1982, you've had roughly tenfold in the Dow and probably similar in the S&P. And with a huge amount of money and with more participants all the time. And there are people coming into the market every day because they feel that they've missed the boat, or they're coming in heavier than they came in before simply because they've had a pleasant experience. And past experience does not mean much in terms of what you should expect from your investments. You will do well in your investments because you own or bought things at the right price and the businesses behave well from that point forward.
Well, you won't have 18 more years at 17 or 18% per annum. That I think we can virtually guarantee.
Question number one, do you think the USA market is overvalued today? And question number two, would you buy Berkshire Hathaway stock today, considering the fact that they have a nice run up already this year? And if yes, presuming I have a kid, 20 years old, and he has $150,000 to invest in Berkshire Hathaway, and he won't need the money until 5 years later, gradually, would you recommend to buy A share or B share or the combination? Thank you.
If you decide to buy Berkshire, I don't think it really makes much difference whether you buy A or B. But we don't make any recommendations about whether people buy or sell Berkshire. We never have, and that's a game we don't want to get into. In terms of overvalue, the question of whether the market's overvalued generally, it's it's simply as we said last year here in the annual report. It's not, the general market is not overvalued if two conditions are met, which is, in our view, which is that interest rates remain at or near present levels or go lower, and that corporate profitability in the U.S. stay at the present or close to the present levels, which are virtually unprecedented. Now, those are a couple of big ifs, as we pointed out. A lot of the stories that came out after the annual report would emphasize one aspect or another, but it's simply, and they say, what does he mean by that? Well, it means exactly what I say. If the two conditions are met, I think it's not overvalued, and if either of the conditions is breached in an important way, I think it will turn out to be overvalued, and I don't know the answer, which is why I put it in the form that I did. It's very tough at any given time to look forward and know what level of valuation is justified. You do know when certain dangerous things appear, and certainly if you're predicating your answer that stocks are okay at these prices, you have, if you come to that conclusion, you have to also come to the conclusion that, in our view, that corporate earnings at present levels are likely to be maintained, and that's a conclusion you would have to come to. I don't think it's obvious that that's the case.
The real long-term rate of return from saving money and investing it has to go down from recent experience in America, particularly equity-related recent experience. The wealth of the world can't increase at the kind of rates that people are used to in the American equity markets, and the American equity markets can't hugely outperform the growth of the wealth of the world forever. We ought to have reduced expectations regarding the future generally.
Yeah, dramatically reduced, because we mentioned earlier 53% of the world's stock market value is in the U.S. Well, if U.S. GDP grows at 4%, 5% a year with 1 or 2% inflation, which would be a very good result, I think it's very unlikely that corporate profits are going to grow at a greater rate than that. Corporate profits as a percent of GDP are on the high side already, and you can't constantly have corporate profits grow at a faster rate than GDP. And obviously, in the end, they'd be greater than GDP. And it's like somebody said that New York has more lawyers than people. I mean, there's certain, you run into certain conflicts in the terminology as you go along if you say profits can get bigger than GDP. So if you really have a situation where the best you can hope for in corporate profit growth over the years is 4 or 5%, how can it be reasonable to think that equities, which are a capitalization of that corporate profits, can grow at 15% a year? I mean, it is nonsense, frankly. And people are not going to average 15% or anything like it in equities. And I would almost defy them to show me mathematically how it can be done in aggregate. I looked the other day at the Fortune 500. They earned $334 billion on and had a market cap of $9.9 trillion at the end of the year, which would probably be at least $10.5 trillion now. Well, the only money investors are going to make in the long run are what the businesses make. I mean, there is nothing added. The government doesn't throw in anything. Nobody's adding to the pot. People are taking out from the pot in terms of frictional costs, investment management fees, brokerage commissions, and all of that. But the $334 million is all the investment earns. I mean, if you own a farm, what the farm produces is all you're going to get from the farm. If it produces, $50 an acre of net profit, you get $50 an acre of net profit, and there's nothing about it that transforms that in some miraculous form. If you own all of if you own all of the Fortune 500 now, if you owned 100% of us, you would be making $334 billion. And if you pay $10.5 trillion for that, that is not a great return on an investment. And then you say to yourself, can that double in 5 years? It can't, the $334 billion. It can't double in 5 years with GDP growing at 4% a year or some number like that. It would just produce things that are so out of whack in terms of experience in the American economy. It won't happen. So, anytime you get involved in these things where if you trace out the mathematics of it, you bump into absurdities, then you better change expectations somewhat. Charlie?
Well, there are two great sayings. One is, if a thing can't go on forever, it will eventually stop. And the other I borrow from my friend Fred Stanback, who I think is here. People who expect perpetual growth in real wealth in a finite earth are either madmen or economists.
One of the places I refer to a lot is Benjamin Graham, and what worries me now is what he referred to as a period in 1929 and the early 30s as a lab experiment where normal intrinsic values and margins of safety broke down, or seemed to anyway. And I wonder how much you think that might happen now in the next few years, and how much you worry about that with the investments you're making.
Well, we generally believe you can just see anything in markets. I mean, just extraordinary what happens in markets over time. It gets sorted out over, eventually. But I mean, we have seen companies sell for tens of billions of dollars that are worthless, and at times we have seen things sell for 20%. A number of things, not hard to find, perfectly decent people running them, sell for literally 20% or 25% of what they were worth. So we have seen and will continue to see everything. It's just the nature of markets. They produce wild things over time. And one of those wild things, and not to get carried away when other wild things happen, because the wild things create their own truth for a while, and you have to, that's the reason they're happening, and people are getting pleasant experiences and all that. You'll see everything if you're around markets for a reasonable period of time. We don't see any great cases of dramatic undervaluation by this market. So it isn't like we're seeing, because there's perhaps this speculative mania in a particular area of the market. We do not see that creating incredible undervaluation other places. What's happening there may lead to undervaluation, a few years from now, or it may not. I don't know that, but it isn't like you can find things that are worth double or thereabouts what you're paying, because frankly there's so much money sloshing around that if you found such a thing, it would be very likely corrected by some buyout types. I mean, we would love to find businesses that are selling for half of what they're intrinsically worth. We don't find that. We do find a lot of cases where we think the valuations on the high side are unbelievable. We have been in periods in the past where we felt almost everything was being given away too. So you'll get those extremes. Most of the time the market's in a position where there's a little of both, but every now and then it gets into a position where there's a lot of one or the other. And we would love it if we could find a lot of reasonable sized companies that were selling at what we thought were half of the intrinsic value. We're not finding them. Charlie?
Well, I do think that the present time is a very unusual period. It's hard to think of a time when residential real estate and common stocks and so on rose so rapidly in price, and there was so much easy money floating around. I mean, this is a very unusual period.
What's fascinating, and I'm sure you thought of it, is that you can now have a business, saw a few of them, earlier this year, we'll say, that might have been selling for $10 billion, where the business itself could not have borrowed probably $100 million in debt with an equity valuation of $10 billion. But the business itself would not, as a private business, would not have been able to borrow $100 million. But the owners of that business, because it's public, can borrow many billions of dollars on their little pieces of paper because they have this market valuation. If it's a private business, the company itself couldn't borrow 1/20th or so what the individuals could borrow. That's happened to a degree before, but this has probably been as extreme as anything that's happened, probably including the 20s. That doesn't mean there's a parallel to it, but it's been pretty extreme. Charlie?
I think it probably is the most extreme that has happened in modern capitalism. In my lifetime, I would say the 30s were it created the worst recession in the English-speaking world in 600 years. And it was very extreme. You could buy all you could eat in Omaha through the 30s for a quarter from Henderson's cafeteria. And now we're seeing the other face of what capitalism can do. And this is almost as extreme as the 30s were, but in a different direction. It's zero unemployment, rampant speculation, et cetera, et cetera. It's an amazing period.
That does not make it easy to predict, however, the outcome. It says to us, though, certain things we want to stay away from. I mean, basically, it's precautionary to us. It does not spell opportunity, although there's no question that in the last year, the ability to monetize shareholder ignorance has never been exceeded, I think. Wouldn't you say so, Charlie?
Yeah, what makes common stock prices so hard to predict is that a general liquid market for common stocks creates from time to time, either in sectors of the market or in the whole market, a Ponzi scheme. In other words, you have an automatic process where people get sucked in and other people come in because it worked last month or last year, and it can build to perfectly ridiculous levels, and the levels can last for considerable periods. Trying to predict that kind of thing, sort of a Ponzi scheme, which is, if you will, accidentally thrown into the valuation of common stocks by just the forces of life, by definition, that's going to be very, very hard to predict. That's what makes it so dangerous to short stocks, even when they're grossly overvalued. It's hard to know just how overvalued they can become in addition to the overvaluation that exists. And I don't think you're going to predict the Ponzi scheme effect in markets by looking at the price of gold or any other correlation.
Charlie and I mean, you're pulling a figure out of the air. We have probably agreed on at least 100 companies, maybe more, that we felt were frauds, bubble type things. And if we'd acted on shorting those over the years, we might be broke now. But we were right on probably just about 100 out of 100. It's very hard to predict how far what Charlie calls the Ponzi scheme will go. It's not exactly a scheme in the sense that it isn't concocted, in most cases, by one. It's sort of a natural phenomenon that seems to nursed along by promoters and investment bankers and venture capitalists and so on. But they don't all sit in a room and work it out. It plays on human nature in certain ways, and it creates its own momentum, and eventually it pops. And nobody knows when it's going to pop, and that's why you can't short. At least we don't find it makes good sense to short those things. But it is recognizable. You know when you're dealing with those kind of crazy things, but you don't know how high they'll go or when it'll end or anything else. And people who think they do, sometimes play in it, and other people know how to take advantage of it. I mean, there's no question about that. You do not have to have a 200 IQ to see a period like that and figure out how to have a big wealth transfer from somebody else to you. And that was done on a huge scale, in recent years.
it's not the, it's not the most admirable aspect of capitalism.
Mr. Munger, this morning while discussing index funds, you used the example of Japan as a real example of poor performance of a major index over a long period. Indeed, the S&P 500 index declined over 60% in real terms from the early 60s through the mid-70s. Could you discuss the mental models you use to consider the impact of inflation or deflation on your investment decisions and the likelihood of either occurring over the next decade?
Well, that's partly easy and partly tough. If interest rates are going to go way up, you can obviously have a lot of deflation of stock prices. And a lot of that happened in the American period you're talking about. What's interesting about Japan is that I don't think anybody thought that a major modern Keynesian democracy pervaded by a good culture in terms of engineering, product quality, product innovation, and so forth, could have a period where you would have negative 13 years without major depression either. I think that and that it would occur while interest rates were going down, not up. I think that was so novel that the models of the past totally failed to predict it. But I think these anomalies are always very interesting. And I think it's crazy for Americans to assume that what's happening in Argentina and what has happened in Japan are totally inconceivable forever in America. They are not totally inconceivable.
You had a huge bubble in equity prices in Japan, and now you've had interest rates go to virtually nothing. You've had the passage of time. The country hasn't disappeared. People are going to work every day, and you've had the Nikkei, now at a third of what it sold for not that many years ago. It's an interesting phenomenon.
And huge fiscal stimulus in the whole period from the government.
Post-bubble periods, I think, depending on how big the bubble is, and how many were participating in it, but post-bubble periods, I think, can produce fallout that not everyone will be terribly good at predicting.
My question I have is, actually, you have already referred to it, that you devote very little time to looking at the total market and look for individual opportunities most. But I was wondering, in the past you made some excellent presentation on points to consider in projecting reasonable 10-year returns for the stock market, and had advised reduced expectations. Where do we stand now on your stock market and economic measurements and expected 10-year returns?
Yeah. Every now and then, I mean, and I really, very infrequently, you probably can say something intelligent about markets as a whole. I mean, you do see circumstances that are extreme enough that you can make a statement that is likely to look reasonably intelligent 5 or 10 years later. And I've seen a few of those times in my lifetime. I mean, and I've spoken out a couple of times, and I did in 69 and 74 and a few times. Most of the time, you're in some in-between zone. Obviously, you get more for your money in equities now than you got, say, in the summer of 1999, which is when I delivered a talk out at Sun Valley that later got turned into an article for Fortune. But that was I spoke out then because it was extreme. I mean, I knew in a general way that I was going to be right, particularly in certain aspects of the market. but I didn't know when, and I didn't know how right or anything of the sort. And you could have done the same thing in the other direction back in the mid-'70s. I think that if you had to make a choice between owning long-term bonds, which are now yielding the Treasury only a little over 4.5%, or owning equities for the next 20 years, and you couldn't make a change that decision, I would certainly prefer equities. But I think people that have expectations that they can earn more than 6 or 7% in equities, and certainly when they start expecting double digits, I think the degree that they have expectations they can do that, or that they can find somebody else to do it for them, I think they're making a big mistake. But 6 or 7% is not the end of the world at all. In fact, and it gets treated better tax-wise right now than it has almost really any time in my lifetime. So I don't think we're in bubble type at all valuations in equities, and I don't think we're anywhere close to, remotely close to bargain valuations, and I don't think it's an extreme enough period that you can speak out in some very definitive way about the outlook. But if you told me I had to go away for 20 years and choose between what's obtainable in an index fund of equities or be committed to long-term bonds, I would rather take equities. But I think you will get a chance to do something that is more screamingly intelligent in not too many years, and maybe a lot shorter than the alternatives that you're offered now. Charlie?
Well, I can't improve on that at all.
Warren and Charlie. Warren, if you were writing a follow-up to the very prescient Fortune magazine article from November 1999, in which you were talking about the lean and fat 17-year periods, what would you be writing? And since we're halfway through this third 17-year period, how is it turning out based on your expectations from back in 1999?
Yeah, the 17 years, of course, I had a little fun with because of the fact that there were two 17-year periods, and there are also 17-year locusts. So I stretched it a little from a literary standpoint, but there's nothing magic about given spans of time. There was something very different between the first 17 years of that 34-year period and the second 17, and I use that for kind of a dramatic contrast. If I were writing something now, I would say what I said just a little earlier in response to Frank Martin's question, that it is, if I had to own long bonds or a long-term position in equities, I'd rather have equities, but I would not have high expectations for them, but I would have expectations beyond 4 3/4%. How much beyond, I'm not sure, but something enough beyond 4 3/4% that I would rather own equities than bonds. I felt in 1999 that people were extrapolating the experience of the previous 17 years and assuming there was something magic about owning equities, and expectations of the people were bound to be people were bound to be disappointed. They simply had an unrealistic view by extrapolation, and that was the main purpose of that article. But if I were writing something now, I would not have high expectations for equities, but I would have better expectations for equities than for bonds. Charlie?
Yeah, and I would say that since that article was written, the results from owning equities have been pretty lean, at least compared to what happened in the glorious 17 years that preceded. So Warren has been right so far, and he's probably right now when he says modest expectations.
Yeah, you really don't have in markets, you can't say something terribly important or intelligent every day or every week or every month. That's one of the problems of if you went on television too often or to write weekly letters or something of the sort. Every now and then you get something extreme. I mean, I did close down the partnership in 1969 and an article appeared. I did give an interview in 74. I gave another interview in 81 or 2. I mean, every now and then things really get out of whack. And, but the gradations in between, they're too tough. But the nice thing about it is you don't have to have an opinion every day or every week or every month. You know, if you own some good businesses and you bought them at the right price, if they get to a silly price, you probably should sell them. And if you find that everything is extremely cheap, like in 74, you should put every available dime into equities, and that's what we've tried to do.
Okay, now let's move to the stock market, a subject of great interest to everyone here, I'm sure. Over the years, you've generally been reluctant to frame a big cosmic position on the stock market.
I've done it about 5 times.
I know, but I think last spring, if I'm remembering correctly, and correct me if I'm not, you said that stocks were neither greatly expensive or really cheap.
Right.
What would you say now about stocks? And in answer, you might also mention what people are now calling the Buffett standard. I didn't even know that. A statistical comparison that Fortune has used and promoted over the years, and tell us how things rank there.
Well, I did use in a talk I gave 15 years ago at Sun Valley and got reprinted in Fortune, a standard of total market capitalization to GDP. And that I used that because it showed at that time how extreme things had gotten. I think they'd gone from
Extremely high.
Yeah, they'd gotten from 40% of GDP, which had been kind of standard over the years, they'd gotten up to like 170% or something. So it wasn't designed to be a fine-tuning type of valuation, but it showed things that really changed in a big way. A very high percentage of the time, stocks are in what I call a zone of reasonableness. This is not something, you know, we all know that pi is 3.14159, and little kids can sometimes give it out to hundreds of decimal places. But the stock market's not like that. There's a range of reasonableness, and most of the time throughout my lifetime, it's sold in the range of reasonableness. That range changes over time as earnings accumulate and interest rates change and all that sort of thing. There's only been about 5 times in my life, I think, that I've actually spoken out publicly to say it was outside the range in one direction or another. The most recent one being in October. I was early in October of 2008, and I said stocks were cheap, and I wrote an op-ed in the New York Times. But I'll probably have some chance, you know, once every 5 or 10 years to make a definitive statement. There is a big zone of reasonableness. Anybody thinks they can pinpoint it is crazy. You know, it's not that precise. And fortunately, you don't need to. You know, if you buy good businesses at reasonable prices and hold them, you're going to make a lot of money. And that's true of stocks as a group. It's true of individual companies.
So you're saying that right now they are in a zone of reasonableness?
They are in a zone of reasonableness.
Okay.
Yep.